Everyone is looking at the wrong number. For years, the loudest voices in finance have been screaming about $34 trillion. They point at the debt clock ticking away in Times Square, warning that the United States is sprinting toward a cliff. But they are missing the real story. The absolute size of the mountain does not actually matter if people are fighting to buy a piece of it. The real panic isn't how much America owes, it is who is suddenly refusing to lend. Most people think the biggest threat to the American economy is reckless government spending. We are told that if Washington just managed its budget like a normal household, the danger would vanish. But that is not how the global financial plumbing works. A government that prints the world reserve currency is nothing like a household. The truth is much stranger and much more dangerous. The United States does not have a spending problem. It has a buyer problem. Think about it this way. If you owe $1 million, but everyone in your neighborhood is begging to lend you more money at next to no interest, you do not have a crisis. You have leverage. For decades, this was America's ultimate superpower. The United States government could spend whatever it wanted because the rest of the world was practically forcing their savings into Washington's pockets. It was the safest bet on earth. But recently, something shifted. The lines at the auction house started thinning out. The giant institutions and foreign nations that used to blindly absorb trillions of dollars of American debt are quietly stepping away from the counter. And that raises a bigger question. If the traditional buyers are walking away, who is left to keep the lights on? To understand how we got here, we have to look at the global financial pipeline. For the last 50 years, global trade ran on a very simple, unwritten agreement. The United States bought manufactured goods and oil from the rest of the world, flooding the globe with American dollars. Then, those foreign countries took those exact dollars and invested them straight back into United States government bonds. It was a perfect self-funding loop. The world got a safe place to store its wealth, and America got to live beyond its means for generations. It felt like a permanent machine. Economists even had a sophisticated name for it: global imbalances. But in plain English, it just meant America had a cheat code. Here is where things get interesting. That cheat code only works if the players trust the referee. A few years ago, the financial world witnessed a subtle, almost silent fracture. When global geopolitical tensions escalated, Western nations decided to freeze hundreds of billions of dollars of foreign central bank reserves. It was a massive statement of power, but it sent a chilling message to every major capital city on the planet. Your savings are only safe if we stay friends. Suddenly, the world's largest buyers of American debt started looking at their portfolios and realized something uncomfortable. Holding Washington's promises was no longer just an economic strategy, it was a political vulnerability. So they started changing their behavior. The major foreign central banks did not completely dump their bonds. That would crash the system and hurt them too. Instead, they just stopped growing their collections. They let their old bonds mature and quietly channeled their new cash elsewhere. Some went into gold. Some went into local infrastructure, but they stopped showing up to the American auctions with the same enthusiasm. Which leads to something even stranger. If you look at the official data from the Department of the Treasury, the mountain of debt is still growing faster than ever. Trillions of dollars of new bonds are being issued every single year. If the world's biggest buyers are backing away, how are these auctions still succeeding? Who is filling the gap? The obvious explanation is that private investors, like hedge funds and mutual funds, are stepping up. And on the surface, that is true. But when you peel back that layer, you find the hidden explanation, and it is far more alarming. The new buyers are not long-term partners. They are short-term speculators. You see, traditional buyers, like foreign governments, buy bonds and hold them for 10, 20, or 30 years. They provide deep, stable foundation blocks for the entire financial architecture. Speculators, on the other hand, are playing a high-stakes game of musical chairs. They're using massive amounts of borrowed money to exploit tiny temporary price differences in the market. They are not investing in America's future. They are trading a volatile asset for a quick profit. And this is where everything changes. Relying on hedge funds to fund a superpower is like replacing the concrete foundation of a skyscraper with a network of hydraulic jacks. It works perfectly fine right up until the moment the electricity flickers. The weirdest part of this shift is how it affects everyday interest rates. When regular, stable buyers leave the room, the seller has to offer a better deal to attract the remaining crowd. In the financial world, a better deal means higher interest rates. Washington now has to pay significantly more just to convince people to hold its debt. Well, this creates a brutal feedback loop. According to projections by a number of economists, the amount of money the United States spends just on paying interest is quickly overtaking major parts of the federal budget. It is outpacing defense spending. It is swallowing up tax revenue. The government is forced to borrow more money just to pay the interest on the money it already borrowed. But that is not the real story. The deeper explanation involves the one institution that cannot allow these auctions to fail, the Federal Reserve System. When a government auction does not attract enough private buyers, the system faces a catastrophic choice. Either interest rates rocket skyward to attract buyers, which would crush the domestic economy, or someone has to step in as the buyer of last resort. In the past, the Federal Reserve System has stepped in, effectively creating new money to purchase those bonds. This is a hypothesis that many macroeconomic analysts are watching closely. If the buyer problem gets severe enough, the central bank may be forced back into the market permanently. But doing that is a dangerous game. When a central bank buys its own government's debt with newly printed currency, it risks degrading the purchasing power of that currency. It is the classic recipe for long-term inflation. So, what is the real explanation behind this entire mystery? The global financial system is undergoing a massive, uncoordinated restructuring. For decades, the world accepted American debt because there was simply no alternative. It was the only game in town. But today, the world is becoming fragmented. Countries are building their own parallel financial plumbing. They are setting up alternative payment networks that bypass traditional Western channels entirely. The buyer problem is not an accounting error. It is a report card on global power. Who benefits from this transition? In the short term speculators and hedge funds are making absolute fortunes exploiting the increased volatility. Alternative asset classes, like physical commodities and gold, are seeing renewed interest as central banks look for places to hide their wealth where no foreign government can freeze it. Who loses? The average citizen. When the plumbing of global finance becomes unstable, the costs are always passed down. Higher interest rates on government debt eventually trickle down into higher mortgage rates, more expensive car loans, and a general tightening of credit for ordinary families. The stakes are continuously growing. We are no longer just talking about a budget debate in Washington. We are looking at a fundamental shift in how global wealth is organized. The ultimate luxury of the American economy was that it never had to worry about where its next loan was coming from. That luxury is slowly evaporating. Which brings us to the bigger implication. If the United States can no longer rely on the rest of the world to fund its deficits, it will have to make choices it hasn't faced since the end of the Second World War. It will either have to dramatically scale back its global ambitions, drastically increase internal taxes, or rely on its own central bank to absorb the debt, risking the stability of the dollar itself. The entire global economy was built on the assumption that American debt is the ultimate safe asset. But safety is not a mathematical formula. Safety is a psychological agreement. As we look ahead, the real number to watch isn't 34 trillion, 35 trillion, or whenever the debt clock reads tomorrow. The number to watch is the percentage of that debt held by the rest of the world. As that number continues to drift downward, the true nature of the crisis becomes clear. The world is not running out of money to lend America. They are running out of reasons to lend it. And that leaves us with an uncomfortable reality that few are prepared to face. If the rest of the world decides they no longer want to buy the American story, who is going to foot the bill?